and what? Forecasting and interpretation. We talked about learning curve, where we said that learning curve here is a method of estimation that takes the general form y is equals a b plus 1 and y bar is equals ax raised to power b, where b we said is your learning curve index, which is given by log learning curve divide that by log who? Log 2. X we said is the activity level or your outputs, or your who? Your output. A is a time or cost of first unit of production of who? Production. Y is a cumulative total time or what? Or cost. Y bar is a cumulative average time. Time or who? Or cost. Remember, we said that when an employee gets used to doing something, they improve their what? The rate at which they produce, and that improvement rate, where they take less time or they incur less cost than the first unit they produced, is what we refer to as what? Learning curve. Is what we introduce as what? Learning curve. And we also said that NB, your learning curve rate is simply 1 minus your improvement rate. Minus your improvement what? Rate. Right, now that I've given you a brief recap of that, today we want to talk about, or I want us to introduce something on variances, where you have what? A learning curve, where you have learning curve. And we are going to do a question of November of 2020. Let's talk about November of 2020. Question 5. Question 5. November of 2020, question 5 is a question we will tackle today, where they're saying High Tech Limited intends to launch a locally manufactured printer in the coming month of December 2020. The Research and Development Department of the company has provided the following information relating to the production of the printer. You have your selling price of 17,500 per printer. Variable production cost, you have direct materials of 800 grams at 7,500 per kg. Direct labor of 75 minutes at 3,000 shillings per hour. Variable overheads of 60% of direct labor hour. Then you have your contribution per printer. Production of the printer is scheduled to commence on 1st of December 2020. The company plans to produce and sell 3,000 printers per month. A direct material loss of 10% is expected, with no resale value. The annual fixed cost attributable to the production of the printer is 60 million. The cost accrues evenly throughout the year. A learning curve effect of 95% is expected. Determine the standard labor cost for the month of December. So let's start with part 1. I want us to determine your standard labor costs. Now your standard labor cost will be determined by your standard what? Labor hours. You multiply by your standard labor rate per hour. Your standard labor hours, you multiply by your standard labor rate per hour. Standard labor cost is given by your standard labor hour. You multiply by your standard labor rates. Which is in shillings per hour. Okay. Your standard labor rate, they've told us currently is how much? 3,000 per hour. But we need to determine our standard labor what? Hours. Keeping in mind that we have what? A learning curve. So let's determine our standard labor hours. So computation of standard labor hours. Computation of standard labor what? Hours. Your labor hours will be given by AX B plus what? 1, where A is the time for the first unit and the time for the first unit is 75 minutes. 75 over 60 hours, which is 1.2 what? 5, which is 1.25. Then your output that you had planned to produce is how much? 3,000 units. 3,000 printers. Then B, we know, is your learning curve index, which will be your log of learning curve, and your learning curve rate is 0.95 divide by log 2, which is negative 0.074. All right. So let's then determine our labor cost, our labor hours first. You're producing 3,000 printers. The time of the first unit is 1.25, but you're producing 3,000 printers. Negative 0.074 plus 1. So therefore, your total labor hours that will be used to produce the 3,000 units, keeping in mind that you have a learning curve of how many? Of 95%, is that you will use 2073 hours. 2073 hours. All right. So your labor, your standard labor costs, your standard labor cost now, you're using 2073.587056 hours. You multiply that by your standard labor rate per hour, and your standard labor rate per hour was 3,000. So therefore your standard labor cost is there, is that 6,220,761.167. all right, that is the first part. Then they're telling us part B to prepare a budget. A budget what? Statement. Budget profit statement. Let's start with your sales. Now this budget profit statement is what sometimes we refer to as an original budget or a static budget. It is a budget where you consider your activity at the beginning and your cost at the beginning. So we normally say it is a budget of budgeted cost, but for budgeted activity. So when you're determining your sales, you're going to take your budgeted selling price, you multiply that by your budgeted units sold. Your budgeted selling price of 17,500, that you multiply by your budgeted units sold, which were 3,000 printers. Then you less your costs. The first cost will be the cost of direct materials, your direct material cost. And your material cost, we're using 800 grams at 7,500, but note number 3, this added and said, a direct material loss of 10% is expected with no resale value, So the 800 grams, therefore, are at 90%. What about 100%? So what will you say? Going to say 800 over 100 kgs. You multiply that by by 100, then times what? Your cost now, your cost in kgs was 7,500 to 7,500. Okay. You multiply by your printers, which are how many? 3,000. Then all these, or let me see, not all these. Then you divide that 100 by what? 90. What have you effectively done? This is what you've done. You've said that 100 is equal to what? 90. What about 800 over 1,000? How much will that? That is what we've done there. Why? Because they're telling us that you have a normal loss of 10% of the material. So even if you bring 100, you're going to get what? 90. And our material, how much at 90% is what? 800 grams. 800 grams, which is 800 what? Kgs. So therefore, at 100, how much do we expect there? So you expect what? 0.88. 0.88. So this 0.88 here, which is now this working, you multiply by the price per kg, then times what? 3,000 printers. That is your material cost. I hope that is very clear why we've worked at it that way. Okay, this, I think even that is what I should write here. So let me write that so that it is very, very clear. 0.88 kgs. You multiply by who? 7,500 per kg. But you had produced how many printers? 3,000. 3,000. All right, that is clear. You then add the cost of direct labor. Cost of direct labor. And because of the learning curve effect, your labor cost, we determined it. We determined it as 62, 20, 761.16 Then you did also have variable overheads. Variable overheads, where they were saying they are 60% of direct labor. So 60% of direct labor on 67. Then lastly, you had fixed what? Overheads. Or fixed costs attributable. For the whole year was 60 million, but you want only for the month of December. So you're going to take 60 million. You divide that by how many months? 12 months. You divide that by 12 months. This is 20 million. This is 37. 324. 56.7. And lastly, your fixed overhead cost is 5 million. So your budgeted profits. This is 556. All right. That is your budget. That is how you apply learning curve as far as variances is concerned. The next part of that question, where they're telling us to reconcile, we will do that in the next lesson, where I will introduce 3 items or 2 items. Number 1, I will introduce operating variances. I will also introduce planning what? Variances. Alright, those 2 things. But for these 2 to exist, you must have what we refer to as revised standards. you must have revised what? Standards for those two to be there, but we're going to talk about them in the next what? Lesson, in the next lesson. So what so far as we've been talking about is conventional variances. Conventional variances, or you simply compare standard or what? Original with actual. You're operating here, you compare your revised and your actual. This one planning is your standard and your actual, but we'll talk about that in the next lesson in more detail. So from me, goodbye and see you next time.
We're done with part A and B. Let's move to part C of this question. Sunny Limited is analyzing two options on how to expand its operations. The following data relates to two options. So we have option A and option B. So we have fixed cost for option A, selling price per unit for option A and B, variable cost per unit for option A and B, the expected sales for option A and B. Then the next page reads, required, Roman 1, contribution margin per unit, 3 marks. Roman 2, the break-even point for both options, 3 marks. Roman 3, the operating income under both options. Number 4, we have advise Sunny Limited on which option is more favorable. Advise Sunny Limited on which option is more favorable. That is the question. So we are first of all to contribute the contribution. Part A of the question reads contribution margin per unit. Contribution margin per unit. This is part C. Contribution margin per unit. That is Roman 1. We can have this thing in a table. We have contribution margin per unit. We can have the formula there. Contribution margin. There are two ways of answering this. I'm thinking of a better way that instead of just answering it straight away, you can have it. You can have this solution in form of a table. You can have it in form of a table. So we have the requirement here. For example, here we have contribution margin per unit. What is the formula? The formula of contribution margin per unit is selling price per unit minus variable cost per unit. That is the formula. So we have contribution margin for product A. Product A. Is it product A? Option A. It's called option A. Option A. And there is option A, option B. Selling price per unit. Contribution margin ratio is equal to selling price per unit minus variable cost per unit. For option A, the selling price is 150. The variable cost for option A is 90 shillings. And therefore, the contribution margin per unit is 60 shillings. Option B, the selling price per unit is 150 shillings. Variable cost per unit is 75 shillings. So 75 deducted from 150, this is equal to 75 shillings. Then Roman 2, what is required for Roman 2? Roman 2, we are to calculate the break-even point for both options in units. Okay. So break-even point in units. This is break-even point in units. The break-even point in units we know is equal to the fixed cost over contribution, fixed cost over contribution margin. That is the formula for the break-even point in units. So from the question we read, option A, fixed cost is 200,000 shillings. This is 200,000 shillings. We divide by the contribution margin, which we calculated here, is 60. So I'll get my machine. 300,000 divided by 60. 200,000. 200,000. 200,000 divided by 60. This is equal to 3,333. 3,333 units. Let's do the break-even point for option B. The break-even point for option B, the fixed cost option B is 280,000. 280,000 divided by the contribution here is 75. So I take my machine again and punch in 280,000 divide 75. So I'm getting here 3,000. This is 3,733 units. To break even, option A requires 3,333 units to break even. Break even is a point where profit is zero. So option A will break even when 3,333 units are produced. Option B will break even when 3,733 units are produced. Then Roman 3, the operating income under both options. Look at Roman 3, operating income. 3, operating, the operating income, how do we calculate the operating income? Look at the question. What information do we have? We have expected sales. So our operating income, we will determine it by using the expected sales. We'll multiply the contribution margin per unit times the expected sales, then we deduct the fixed costs. So the formula for operating income will be the contribution margin per unit times the expected sales, deduct fixed costs. This is contribution margin per unit times the expected sales. We have the expected sales in units. The expected sales we have from the question in units. We deduct the fixed cost. So the contribution for option A, we have it here. This is 60 shillings times expected sales. From the question, expected sales is 6,000 units. The company is expected to sell 6,000 units. This will give us the contribution. Then we deduct the fixed cost for the option A, which is 200,000. 200. How much is it? This is 60 times 6,000. 200,000. This gives me how much? 60 times 6,000. This gives me, how much is this? The expected sales is 6,000. So let me take it again. 60 times 6,000. What is the fixed cost? The fixed cost is 200,000. The fixed cost is 200,000. Fixed cost is 200,000, which is equal to, this gives me 160,000. That is the operating income for option A. For option B, The contribution is 75. The company is expected to sell again 6,000 units. That is the total contribution. We deduct fixed cost of 280,000. So I have 75 times 6,000 minus 280,000. So this is equal to 170. Operating income, option A, 160,000, option B, 170,000. I'm moving on well. Are you following, candidates? You need to memorize the formula. For you to be able to answer such a question, you have to have this formula in your head. Formula for contribution margin, formula for break-even point is a formula for operating income. Operating income, we take the contribution margin per unit, we multiply by the number of units. For option A, 6,000, option B, 6,000, we get the total. Then we deduct this cost to arrive at the operating income. Then what else is required from this question? Roman 4, advise the company on which option is more favorable and why. Definitely option B is more favorable. Number 4, option B is more favorable because it has, or it promises, a higher operating income of shillings 170,000. You see, this one is higher than the 160,000 because companies are in business to make more income. If option A promises 170,000 shillings, option B promises 160,000 shillings, it's better to take the one that promises a higher operating income. So that is it, candidates, for today's lesson, in which you have answered the question that was tested in August 2025, question 4. We will continue to provide more solutions to these questions. If you have any queries, feel free to ask your questions, and all your questions will be answered. Bye-bye. I greet you all and welcome you back to the governance and compliance audit lesson. Today, our focus is on the governance and compliance audit checklist, which is a practical tool used in the planning phase to ensure that all critical aspects of the audit are considered and addressed. So there has to be, at the planning stage, a checklist which acts as a summary of the planning process, and it provides a final check to confirm that the audit is ready for execution. In this lesson, we are going to break down the key planning phases that are covered in a checklist. And the first one is the initial consideration and scope. Initial and scope. All right. Initial consideration and scope may cover areas like the audit purpose and objectives. The checklist must answer questions like whether the audit objectives have been clearly defined. Have the audit objectives been clearly defined? The objective could be to assess compliance with the data protection laws or to evaluate board oversight and so on. Another question here at this point is the audit, if the audit has been approved by the appropriate authority. Has the audit been approved by the appropriate authority? And the appropriate authority could be the audit committee, it could be senior management. So one aspect of the checklist is the audit purpose and objectives. Then there is audit scope. Audit scope. Is the audit scope clearly defined, including the specific business units, the processes, systems that are to be audited? And have any exclusions or limitations to the scope been clearly stated and agreed upon? Has the time period to be audited been specified? So those are aspects of the audit scope which have to be covered in the checklist. So there has to be that part of the checklist which has to be ticked as the planning phase comes to an end. Then you have understanding the entity. Understanding the entity. Here questions to answer are, have we reviewed the entity's organization structure and key business processes? Another question is, have we identified the relevant industry and legal regulatory requirement? Have we gained an understanding of the entity's risk management and internal control frameworks? So that is very important. At the initial consideration scope, part of the checklist should be this, answering these three questions. Then the second part, the second aspect is our phase. So this is just phase 1. Then phase 2, we have risk assessment and strategy. Assessment. Now here we are talking about the risk assessment. Risk, number 1, is risk assessment. What questions should be answered here? 1, have we conducted a preliminary risk assessment to identify high-risk areas of non-compliance? Number 2, have we identified the inherent and control risks for the key audit areas? Then there is also the aspect of materiality. After dealing with risk assessment, there is a materiality, particularly the thresholds. Have we determined the quantity, the quantitative and the qualitative materiality thresholds for the audit, e.g., the specific legal violation is always material and so on. Then 3 is assurance level. Assurance levels. Have we determined the level of assurance to be provided? Is it reasonable level of assurance? Is it limited level of assurance? Is it agreed upon procedures? And does the chosen assurance level meet the expectations of the key stakeholders? That is the assurance level. Then there is, of course, the audit strategy. Audit. Now, audit strategy candidates, we have to check whether there has been an overall audit strategy. Has an overall audit strategy been developed and documented? Has the audit team been assembled with the necessary skills and expertise? Have the threats to audit been identified, and has a plan for safeguards been developed? So that's part of the second phase. Then the checklist for the third phase is the detailed planning and documentation. Detailed and documentation. Detailed planning and documentation. Here we are dealing with the subject matter and criteria, for example. Subject and criteria. Subject matter and criteria. Have the question to answer is, or what to check is, if there has been specific subject matter. What is being audited? That is the subject matter. and the criteria, which is the benchmark, have these two been clearly defined? Another question is, have we prepared a governance and compliance matrix linking requirements to controls and audit procedures? 2, audit plan and program. Candidates, we are discussing the checklist, which you have defined as a summary of the planning process, right? Which provides a final check to confirm that the audit is ready for execution. Now, the questions to answer in relation to audit plan and program is that 1, is the final audit plan drafted and approved? Has it been approved? Number 2, is the detailed audit program complete with specific step-by-step audit procedures? Number 3, does the program specify the evidence required for each procedure? Then, of course, we have the resource allocation. There is the aspect of resource, let me call it resource management. Resource management and logistics have the necessary resources like personnel, budget, and technology been allocated? Number 2, have we established realistic timeline with key milestones for the audit? Number 3, have we planned for access to key systems, documents, and personnel? So this is phase number 3. There has to be a checklist for subject matter and criteria, audit plan and also program, then resource management and logistics. Let's move to fourth phase. The fourth is the final. There has on final preparations. Having dealt with the detailed planning and documentation, there is also final preparations like issues to do with the working papers, communication. You have working papers. There is issues to do with communication. Now, the question to answer on working papers, for example, it would be, have the permanent and current files been set up? Have they been set up? The permanent file, has it been set up? The current file, has it been set up? Number 2, have all planning documents been properly documented and indexed in the working papers? And there are also questions to answer on communication. Has a kickoff meeting, for example, with the audited department been scheduled? Has a formal communication plan been established to keep the stakeholders informed throughout the audit? There could also be questions to answer on review. On the final preparation, we have the working papers, communication, and also review. And let me put it together with approval. Review and approval. All right? For example, has the entire audit plan been reviewed by senior member of the audit team? Has the final audit plan been formally approved before fieldwork begins? So those are questions that are to be answered when preparing the checklist before the audit commences. There has to be a checklist, candidates, which is a practical tool that is used in the planning phase to ensure that all the critical aspects of the audit are considered and addressed. So before getting into the fieldwork, there has to be a checklist, and all the questions that we'll be discussing are addressed so that nothing is left to chance, so that there are no omissions when the audit commences. So using such a checklist ensures that the audit team has considered all the critical elements of the planning phase, setting the stage for a thorough, effective, and well-documented audit engagement. So that's all for the governance and compliance checklist. I'll meet you in our next session where we continue to learn more on governance and compliance audit. Bye-bye.
Welcome to Manifested Publishers, to Advanced Management Accounting. My names are Mr. Bariga, and we will be continuing with CVP under conditions of uncertainty. So far, we've covered 5 methods of CVP under conditions of uncertainty. We have covered the expected value approach, simulation approach, decision tree, sensitivity analysis. So today, we will cover continuous or normal distribution method. We've also been able to cover statistical analysis method. So out of the 6 methods that are used to deal with CVP under conditions of uncertainty, the one remaining is continuous distribution method or normal distribution method. And that is what we will talk about today. So F normal distribution, then a normal distribution is normally a bell shape, or is a distribution that can be illustrated using a bell. Okay, so we say it is what? Bell shape. So it looks like this. And a normal distribution, we say it is correctly defined when you have been given the expected value or the mean, and you have also been given the standard deviation. Okay? What half of this distribution can to exactly fit the half. So into half, they should exactly fit each other. It is also important to remember that this do not intersect or meet. Why? Because we say it is what? Asymptotic. Okay? Good. One half of that is 0.5, and that other half has a probability of 0.5. So that when you add them, it is equal to what? To 1. So this X bar is your mean, and that is your standard deviation. Standard deviation. That. Okay? So we can have an example. We can have an example of a question where we will be talking about what? CVP. Yeah? So we can say that given a selling price per unit of 1250, a variable cost of 500, your expected sales of what? 200. Expected sales of 200 and expected sales of 200 and the standard deviation, a standard deviation of what? Of 300, and the standard deviation for how much? Can say 300. Compute the break-even point. Compute break-even point. Yeah. In what? Units. Given that your fixed cost is how much? Your fixed cost is 1.2 million. If given that your fixed cost is, let me say 120,000. Your fixed cost is 120,000. Okay? The second part, compute probability of at least break even. Of at least break even. At least break even. Then number 3, compute probability of achieving target sales. Target sales given that target sales is is 200,000. Given that target sales is 200 what? 1,000. Target sales profit. Given that target sales profit. So there's that. Target sales profit. Given that target sales profit is 200,000. It's 200. Alright. So we can have a solution here. This is a section. Your break-even point number 1, if you want it in unit, let's say you simply take your fixed cost, divide by contribution margin. Divide by contribution margin. Your fixed cost is 120,000. Divide by a contribution margin, and the contribution margin is the difference between your selling price per unit and your variable cost, which will be how much? 1250 minus 500. That should be 750. So therefore, your break-even point will be 160 units. 160 units. Part 2 of that question is compute the probability of at least break even. So what you do is you represent this using a normal distribution.
The normal distribution looks like that. The mean is, you have to look the mean here. Can say that your mean turns out what? And
simulation is a quantitative method of analyzing uncertainty. Simulation is a quantitative technique of analyzing what? Uncertainty. And with simulation here, there are some basic requirements that you must be provided for. For you to be able to simulate a question, so these are the requirements that you must have in a question. Number one is a probability distribution. You must be given the probability what? Distribution of each variable you want to simulate. Of each variable. That is the first thing you must have. So if you want to simulate sales, they must give you probability distribution of what? Sales. If you want to simulate the quantity, they must give you what? The quantity. Number two, you must also determine your cumulative probabilities. You must determine your cumulative probabilities of each variable. The cumulative probabilities of each variable. Once you have the probability, you can now determine your cumulative probability by adding. The third item you want to have is you're going to get your random number ranges. Your random number ranges. Show you that. Then number 5 is you must also have your random numbers. Random numbers here basically are numbers assigned that show equal chance. They are numbers assigned that show equal chance of occurrence. So random numbers. Once you have determined your random numbers, or once you've been given your random numbers, this case in an exam situation, they will always provide the random numbers. Number 5 is you set up your simulation worksheet. Your simulation worksheet. You must set up your simulation worksheet where you're going to simulate your information. Those are the requirements that are required for us to be able to carry out what? Simulation. So I want us to go to a question. Let's go to December of 2022. December 2022. Question 2A. Question 2A. December of 2022. Question 2A. They are saying, Lengo Limited is considering marketing a new product. The fixed cost of this product will amount to 5 million. There are 3 uncertain factors, namely selling price, variable cost, and annual sales volume. Selling price is for 400, for 50, and 500 with a probability of 0.3, 0.5, and 0.2 respectively. Variable cost is 200, 250, and 300 with a probability of 0.1, 0.6, and 0.3. Your annual sales volume in units is 40,000, 50,000, and 60,000 with a probability of 0.4, 0.5, and 0.1. Additional information. Assume that the 3 factors are statistically independent. The company uses cost, volume, profit analysis to make decisions. The following random numbers are provided. You have your selling price with a random number of 8, 0, 6, 1, 3, 5, 1, 3, 9, and 1. The variable cost, the random numbers are 0, 4, 3, 4, 6, 7, 2, 8, 5 and 9. So let me repeat the variable cost random numbers: 0, 4, 3, 4, 6, 7, 2, 8, 5 and 9. The sales volumes had the following random numbers: 6, 3, 9, 4, 0, 9, 7, 6, 8 and 5. Required. Using CVP analysis criteria, simulate the problem and determine the average what? Profits. Simulate the problem and determine the average what? Profits. Number 1. For us to do this question, we must confirm what we've been given. Have we been given the probability distribution of each variable? Yes, we have been given. So, come here and get the selling price. We have the selling price. You have the shillings, the selling price in shillings: 400, 450 and 500. Your probability, which I denote as P naught, is 0.3, 0.5 and 0.2. Let's get our cumulative probability. Let's determine our cumulative probability. This is 0.3. 0.3 plus 0.5 is 0.8, and that is 1.0. The next variable that we have probability is variable cost. So remember, all these uncertain items, you must be given probability. You must be given what? Probability. Your variable cost is 200 with a probability of 0.1, 250 with a probability of 0.6, 300 with a probability of 0.3, 0.3. So that now your cumulative probability is 0.1, 0.7 and that is 1.0. That is for who? For variable costs. The third item that we have our probability distribution is your sales volumes in units. In units, the units are 40,000, 50,000 and what? 60,000. Your probabilities 0.4, 0.5 and 0.1. We need to determine our cumulative probabilities. 0.4, 0.9 and that is 1.0, 1.0. Right. So what we have effectively done is we have the probability distribution. Then using the probability of each variable, we have determined our cumulative probabilities. Our cumulative probabilities. That is in order. All right. Once we have done that, we then need to determine our random number what? Ranges. Our random number ranges. So let me come back here. Computation of random number ranges. So let's again start with selling price. 400, 450, 500. Your probabilities 0.3, 0.5, 0.2 your cumulative probabilities 0.3, 0.8 and 1.0. Then your random number ranges, I'm just going to write them there, your random number ranges there. Now your random number ranges will be between 0 and 2. So we normally say when you're determining random number ranges, the ranges should be inclusive. They should be inclusive, such that if you start between 0.2, then the next observation should be between 3 and 7. Then the next one is between 8 and 9. 8 and 9. Okay? That is the selling price. Let me go to what? Variable cost. Some of these items I am repeating, which is also in what? Shillings, probability, cumulative probability and random number what? Ranges. $200, $250 and $300. Probability is 0.1, 0.6, 0.3, 0.1, 0.7 and 1.0. The random number ranges now will be between 0 and 0. Why? Because we've said it must be exclusive. It must be inclusive. It must be inclusive. Then 1 to 6, 7 to 9 must be inclusive. That is your variable cost. Let's now finalize determining the random number for sales volume. Cumulative probabilities 40,000, 50,000 and 60,000, 0.4, 0.5, 0.1, 0.9 and 1.0. Then we must determine our random number what? Ranges. So this is 0 to 3, 4 to 8, 9 to just 9. Summer 9 or 9 to 9, no problem. 9 to 9 there. So remember, what guides us when you're getting the random number ranges? Number one is the decimal point. So if we had two decimal points here, for example 0.30, I would have written my random number ranges in tens, not ones. Here they are in ones because the decimal place is in one place. So if they are more than what? One decimal place, if it is more than one decimal place, I will also have the random number more than once. More than once. So let me adjust that. Right. That is wonderful. Let's now prepare our simulation worksheet. Our simulation worksheet. Okay. We have already been provided the random numbers, so that we have. So we want now to prepare our simulation worksheet. When you're preparing this simulation worksheet of CVP, you're going to prepare it according to what is being asked in the question. And here they are telling us required, simulate the problem and determine the average what? Profits. How do we get your profits? You say it is P minus V by the units minus your who? Fixed costs. Minus your fixed cost. So this is how your simulation worksheet should look like here. Okay. So the first item should be your selling price. But because selling price, you've been given random numbers and the probabilities, so because it was uncertain, we will come here and write the random numbers and your selling price P. There. The variable cost, we did also being provided the variable cost, their probabilities and random numbers. So again, we introduce random numbers for variable cost and who? And the variable cost there. Then your random number for the units you want to do what? To sell, for the units Q. For your units. Then we know, or we can first determine our contribution margin. Let's first determine our contribution margin CM, which is given by P minus V. So this is not really a requirement, but let's just determine it. If you're able to just compute directly, well and good, but let me show you that so that we simplify our work and we look more organized. Okay, so that is P minus V, contribution margin. Let's get the random numbers for your units, for your units. Then we get our total contribution and your fixed costs. And then lastly, your who? Profit. Lastly, your profit. We can even try squeezing this. Left so much spacing. So we can readjust this. I'm just rewriting this so that it is better off for you. It is better off for the students to see. And fixed cost, and then your profit, and then your profit. All right, that is how a simulation worksheet of CVP should look like. The first random number of selling price is 8. And with the selling price of 8, or rather with a random number of 8, your selling price is between 8 and 9. The random number, you normally read it according to the random numbers. So you go to your selling price, and where you have a random number of 8 and 9 is at a selling price of how much? 500. So here you're going to write what? 500. Then variable costs random number is 0. Your variable cost with the random number, when your random numbers are 0, your variable cost is 200. Then your contribution margin will be 300. Why? 500 minus 200. The next random number of sales volume is 6. And with the sales volume of 6, of random number 6, your units should be 50,000. Then to determine our total contribution, you're going to take your contribution margin by your units. So I believe that is 150 or 15. 1, 2, 3, 4, 5. Your fixed cost was 5 million. Fixed cost was 5 million. Then you get your what? Profit. Then you get your what? Profit. Is that a profit of 10 million? That is a profit of what? 10 million, All right. The next random number is 0. So allow me to just write these, all of them together. 0, 4, and 3. With the price of 400. Why? Because with the selling price of 450 actually, because your random number is between 3 and 7, So 450. Let me see. Yeah. Your random number is 0. So your selling price is 400. Don't get this confused here. 400. With a random number of 4, your variable cost is 250. So your contribution margin is 150. With a random number of 3, you're selling how many units? 40,000. Okay, we'll come back to the contribution. Then 6, 3, 9, 1, 4, 4. Just highlighting the random numbers now. 3, 6, 0, 5, 7, 9, 1, 2, 7, 3, 8, 6, 9, 5, 8, 1, 9, 5. All right. The random number of 6, your selling price is 450. 1 is 400. 3 is 450. 5 is 450. 1 is 400. 3 is 450. 9 is 500. 1 is 400. Variable cost of 3 is 250. 4 250. 6 250. 7 300. 250. 8 is 300. 250. 300. So remember, what is guiding us is our ranges. The quantity, 9 is 60,000. 4 is 50,000. 0 must be 40,000. 60,000. 7 is 50,000. 6 is 50,000. 50,000. And lastly 50,000. This is 200. 150. 200. 150. 150. 150. 250. 100. Then what do we do now? We get our total contribution. 150 by 40 million. 40,000. That is 6 million. Your fixed cost is 5 million. 250. 200. 200 by 60,000. This is 12 million. That is still 5 million. So that should be 7 million. 7.5 million. 5 million. 2.5 million. This is 8 million. 5 million. If fixed cost is not changing. 3 million. 9 million. 5 million. 4 million. 7.5. 5 million. 2.5. 7.5 million. 5 million. 2.5. So remember, your total contribution is contribution margin by the units. Please don't forget. That is why 300 by 50 is that. What have you? 250 by 50,000 must be 12.5. And that is 5 million. 7.5. This is 5 million. Then we get our profits. Let's get our profits. We simply add these profits. plus 2.5 plus 2.5 plus 7.5. Is that 40 million? So therefore your average profit, remember in the question they are asking for average what? Profit. Going to take 40 million, divide by the number of times you've simulated. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 4 million is your average profit. 4 million is your average profit. And that's how we simulate what? CVP. That is how we simulate CVP. All right, I hope that has been properly understood, such that if it comes to question, you will be able to do what? To handle it. So the remaining items is sensitivity, statistical analysis, probability tree diagram, and continuous or normal distribution. Continuous or normal distribution. All right. Now, we're going to cover these next items during the next what? Session. During the next session. So from me, I wish you the very best and see you in the next session. Goodbye.
I'm glad to welcome you back to the lesson. Today we continue with the subject governance and compliance audit. Our focus today is on levels of assurance, determining the level of assurance, which is a very critical step in the planning phase of the governance and compliance audit, because it directly impacts the scope, the audit procedures, the amount of evidence required, and also the nature of the final report. And unlike the financial audits, where the standard is often reasonable assurance, governance and compliance audits may have more flexibility in the level of assurance that is sought. And the level of assurance candidates is just a measure of the confidence that the audit team provides to stakeholders regarding the subject matter. Assurance comes from the word assure, to assure. When the auditors examine the records, the objective is to provide assurance on the subject matter and its spectrum, not a binary choice, and it's not a binary choice, but it's just a professional judgment call based on the auditor's objectives, risks, and also stakeholder expectations. So when conducting a governance and compliance audit, just like the financial audits, the auditors are required to provide some level of assurance. And the levels of assurance may be categorized into three. One is the reasonable assurance. Number two is the limited assurance, and no assurance. That is what we are going to study in our today's lesson. Levels of assurance. There are generally three levels of assurance that can be provided in a governance and compliance audit. And the first level, I've mentioned it, which is a reasonable assurance. A reasonable assurance is a high level assurance, okay? But it's not absolute assurance. And here, the auditor gathers sufficient appropriate evidence to conclude with a high degree of confidence. But that degree of confidence is not 100% certainty. Okay? but it is just, it indicates what we call materiality compliant with the criteria that is established. You understand? It is a high level assurance. A reasonable assurance is a high level assurance. And this level requires extensive and rigorous procedures. The audit team must perform detailed testing. It has to do what we call substantive procedures. It has to verify controls and compliance activities. And it often includes a combination of inquiries. The auditors have to make inquiries. The auditors have to inspect documents. They have to observe processes and also reperform procedures. You understand? For you to provide a high level assurance, for the auditor to provide a reasonable assurance, the auditor has to carry out substantive procedures. And the final report provides what we call a positive opinion. It provides a positive opinion that in the auditor's judgment, the organization's controls or compliance activities are effective and free from material non-compliance. The auditor can only give that opinion after conducting thorough investigation, after ensuring that he's done detailed testing, after the auditor has verified controls and compliance activities. It is only then that the auditor can give a high level assurance or a reasonable assurance. You understand? And this level candidate is chosen for high risk areas where non-compliance would have a severe impact. Examples could include audits required by law or regulation. It could be audits of critical financial controls or data security systems. Another example could be audits where there is a high potential for reputational damage or significant financial penalties. You understand? Yes, you need to understand, candidates, that when called upon to carry out a governance and compliance audit, as an auditor, you may be required at the end of the day to provide assurance to the stakeholders. And that assurance can be categorized into three: reasonable assurance, limited assurance, and no assurance. We've defined reasonable assurance as high level assurance, but it's not absolute assurance. We say that in a reasonable assurance, the auditor gathers sufficient appropriate evidence to conclude with a high degree of confidence that the subject matter is materially compliant. And we'll give an example. It could be audits that are required by law or audits of critical financial controls. It could be audits where there is a high potential for reputational damage. Then there is a second level of assurance, which is a limited assurance. On the other hand, what does it mean? This is a moderate or less reasonable assurance. It's a moderate assurance. And the auditor here has to perform fewer procedures and therefore provides a lower level of assurance because he has conducted fewer procedures. You understand? And the conclusion is often negative. Here we said the opinion or conclusion is positive. Positive. Here the conclusion or opinion is negative. What do we mean by negative? Negative. The opinion here is negative. It is a negative one, stating that based on the work performed, nothing has come to our attention. That is what the report will read in a limited assurance. Based on the work performed, nothing has come to our attention that causes us to believe there is a material non-compliance or significant control weakness. Okay? Nothing has come to our attention. That is being negative. Nothing has come to attention. Having carried out few procedures, nothing has come to our attention that causes us to believe that there is material, that there is a material non-compliance or significant control weakness. And unlike reasonable assurance, procedures are less, procedures are fewer, procedures are less extensive than a reasonable assurance engagement. And here the auditors often rely on inquiries. Okay? They do not carry out substantive procedures. They rely on inquiries, on just interviewing the personnel, carrying out analytical reviews, and so on. Okay? And high-level inspections rather than detailed testing of transactions or controls. And the focus is on plausibility rather than detailed verification. In limited assurance engagement, there is limited engagement. There is limited. It's limited. Okay? Testing is limited. And that's why the degree of assurance is low. And the final report provides a limited opinion, which is a less definitive statement than a positive one. It is not as definitive as a positive conclusion or a positive opinion. And this level of candidate is often used for areas of lower risk. If there are areas of lower risk of non-compliance, you apply this level of assurance. But if it is a high risk area, then you have to do substantive testing in order to come up with a reasonable assurance. Okay? Or when there is a quick or cost-effective review that is needed. It can also be good when starting. It can be a good, let me put it, it can also be a good starting point for a new audit area or an immature compliance program. And examples of limited assurance could be a review of an organization's, say, environmental and social activities. Okay? A review of an organization's maybe first-time environmental or social governance. Or just another example could be an initial assessment of a new business process or internal management requested reviews of routine operations. Is that clear, candidates? That is limited assurance. Then we have the third level, no assurance. There are times when no assurance is required. 3, no assurance. No assurance. In no assurance here, we are referring to the agreed upon procedures. Agreed upon. Here, the audit team performs a specific set of procedures agreed upon in advance with the client, and no opinion or conclusion is required. no required. The auditor agrees with the client to carry out certain procedures without having to provide any opinion on the work that has been done. And the report simply lists the procedures performed and the factual findings. The scope and procedures are narrowly defined and agreed upon by all parties, and there is no independent judgment or opinion expressed by the auditor. And in a no assurance level kind of engagement, the report states that the report states the factual findings. Okay, the report will just state the factual findings. The report may just state the factual findings. Okay, the auditors may, for example, say, we observed X number of instances where policy was not followed. Okay, and such candidates example of assurance is appropriate. For example, for specific or targeted reviews where management needs a quick check on a particular area without a full audit. Maybe the management will need to have an understanding of what is going on, all right, and so on. So here, no conclusion is required. Understand? Yes. Now, in closing, let's briefly discuss factors determining level of assurance. Factors determining level of assurance. What are the factors that may determine the level of assurance? Now, the decision on which level of assurance to seek is a strategic one that is made in the planning phase, often in consultation with the client's committee and senior management. And there are various factors that will determine whether the auditors will provide a reasonable assurance, limited assurance, or no assurance at all. And one such factor is risk. You recall when discussing the reasonable assurance, we say that this kind of engagement is carried out on high-risk areas. The level of inherent and residual risk in the audited areas is the most important factor. High-risk areas require a high level of assurance, and low-risk areas may require limited assurance. So risk is a factor. The second factor is stakeholder expectations. Expectations of the stakeholders. What level of assurance do stakeholders expect or require? And these stakeholders could be the board, the regulators, the investors, and so on. For example, a company preparing for public offering may need a high level of assurance than a privately held company. Number 3 is cost or resources. Cost or resources. A reasonable assurance engagement requires significantly more time, more resources, and a larger budget than a limited assurance review. Why? Because to carry out reasonable assurance, to provide reasonable assurance, we say that substantive testings must be done, detailed tests must be carried out, and to do such kind of testing, the auditors require a high budget. Number 4, maturity of the control environment. Maturity of the control environment is also a factor that will determine the level of assurance. If an organization's controls and processes are new or immature, it may be more practical to start with a limited assurance review in order to identify major gaps before investing in a full reasonable assurance audit. That's a fourth factor. Now, the fifth factor is regulatory requirements. Regulations. Some laws or regulations explicitly require a specific level of assurance. The regulators may insist that certain audits be performed. So candidates, that's all. That's all for our today's lesson on levels of assurance, which is a high level assurance. Then we have limited assurance level, which is a low level assurance. Then there is no assurance, agreed upon procedures. In a reasonable assurance, a positive conclusion is made. In a limited assurance, a negative conclusion is made. Where there is no assurance required, no opinion or conclusion is required. Then in this lesson, we've discussed 5 factors that determine the level of assurance. The first and key foremost important, the most important factor is risk. Number 2, stakeholder expectation. Number 2, stakeholder expectation. Number 3, we have cost and resources, maturity of control environment, and regulatory requirements. So it's important to consider these factors. And by carefully considering these factors, the audit team can determine the appropriate level of assurance, ensuring that the audit provides the right amount of confidence and the right amount of value without being unnecessarily burdensome or unnecessarily costly. It's important to consider these factors such that when the audit is carried out, such an audit is not a burden to the client or a burden to the audit team. Thank you. God bless you. Bye-bye.
Now, you can look at a similar question, the previous question. You can look at a previous question. It's been tested just a few semesters back. Let's go to September 2021. September 2021. September 2021. Question who? 5B. September 2021. Question 5B. The question is saying the standard cost of certain chemical mixture is 40% material A at 20 per kg, 60% material B at 30 per kg. The standard loss of 10% is expected during production. During the month of July, the actual data was as follows. Material A used 90 kgs at a cost of 18 per kg. Material B used 110 kgs at a cost of 34. The weight produced was 182 kgs of good production. Let's start by getting our material mix, our material price variance. Our material price variance, you say it is your actual quantity, standard price minus actual price, Your actual quantity, you have 2 types of materials, A and who? B. The actual quantity you purchased was 90 kgs. The standard price per kg was 20 minus an actual price of 18. For material B, your actual quantity was 110 standard price per kg was 30 and your actual price per kg was 34. 30 minus 34. This must be 180. That must be 400 and what? 40. The standard or the material price variance here for A, you had budgeted to buy at 20, but instead of buying at 20, you bought at what? 18. So that's good. So that is what? Favorable. B, you had budgeted to buy at 30, ended up buying at 34. So that is also what? That is adverse because you've spent an extra amount. Then you confirm what kind of variance this is, and this is 250, which is what? Adverse. 260, which is adverse. That is your material price variance. Let's get our material mix variance. And how do you get your material mix variance? You say it is your standard price, your actual quantity in standard mix minus your actual quantity in actual mix. Standard price, actual quantity in standard mix minus actual quantity in actual mix. And actual is standard price B. The standard price of A is 20, B is 30. Your actual quantity that was used is 90 for A and 110 for B. Your standard mix, the ratio of how you are using your materials is 40 is to 60. That is 200. That is 100. Therefore, actual quantity in standard mix. You simply share the actual quantity using the ratio of your standard mix. Using the ratio of your standard mix. And how will that be? This will be 40 over 100 times 200. 60 over 100 times 200. That is 80, and that is what? 120. Alright, your actual quantity in actual means we said, in actual mix we said is your actual quantity. So let's get your material mix variance here. Your standard price is 20. Actual quantity in standard mix is 80. Minus an actual quantity of 90. 100. Standard price of 30. Actual quantity in standard mix of 120. Actual quantity in actual mix of 110. This will be adverse, favorable. So that in total, that will be 100 favorable. Okay. The next item they are asking us to determine is your material yield what? Variance. Material yield variance. You said, how do you get that? You simply take your standard material cost per unit into bracket your standard yield minus your actual yield. Standard yield minus actual yield. Let's determine our standard material cost per unit. They were saying there that the standard cost of material of a certain chemical, 40% of material B was bought at 20, 60% of material B was bought at 30. So therefore, your material cost per unit, you're going to take those percentages times the price of each. which will be 26. That should give you 26. Let's determine our standard yield. Then now need to determine our standard yield. Now they were saying the standard cost of a certain chemical mixture is 40 and 60, and a standard loss of how much? 10% is expected during what? Production. Okay, so this is what we do here. We first identify the input materials that were introduced and the output that was done what? Produced. Okay, and here with an 100% input of materials, with an 100% input of materials, your output was 90%. Your output was what? 90%. Why? Because of a standard loss of 10%. Okay. If you introduce 200, this can ignore this percentage here, that way. If you introduce 200, how much should have been your standard yield there? Your standard yield should have been 180 units. If you are to use the material in the same way you are using according to what you budgeted, you should have produced 180 units. So your yield variance will be 26, 180 minus an actual yield of 182. Your actual yield is 182. This is 52, which we are going to say is what? This is an output. This is output. So yield means output. So we are going to say it is what? Favorable. Favorable. Okay. Your material usage variance, it's going to be your material mix variance plus your material yield variance. Plus your material yield variance. Your mix variance is 100 favorable. Your yield variance is 52 favorable. So that is 162 what? Favorable. Let's determine our material cost variance, which is your material price plus your material usage variance. Your price variance is 260 adverse plus 162 what? Favorable. Which means that is 98 what? Adverse. 98 adverse. And that is how you determine your what? Your advanced variances of who? Of material. Those are the advanced variances of what? Material. All right. Now that we have understood the advanced variances of material, we also should look at the advanced variances of labor, the advanced variances of fixed overheads, and also the advanced variances of sales revenue. Okay. All right. I hope that has been clearly understood. That has been clearly understood. That has been clearly understood. Right. Now, when we meet in the next lesson, we will introduce the advanced variances of what? Labor. We will introduce the advanced variances of labor, which will be in the next lesson. So from me, you can attempt a question to give you a question that you can attempt in your own free time. You can look at August 2022 question 5B as an assignment just for your practice. Your assignment. Please look at this question for your own practice. August 2022 question 5B. Question 5B. There is a variance of what? It is an advanced variance of materials. All right. So allow me, and on behalf of the institution or on behalf of Manifested Publishers, we can call it a day. See you next time when we will tackle labor variances and overhead variances and sales variances that are advanced in nature. So goodbye and God bless you. See you next time. Welcome to Manifested Publishers. My names are Mr. Mariga. I'll be teaching Advanced Management Accounting, and today we will continue with the topic of planning and decision making technique. Specifically, I want us to talk about the various applications of marginal costing. The various applications of marginal costing. Now, marginal costing is a method of costing, or is a costing method that requires the user to determine variable costs, such that your variable costs will comprise of direct materials, direct labor, direct expenses, and variable overheads. Overheads. Right. This method, known as marginal costing, is also known as contribution costing, or variable costing, or direct costing, It is referred to the above names because you consider both, you consider direct cost as part of your production costs. You also consider variable cost when you're determining your production costs, So therefore, using marginal costing, your variable production costs will be made up of direct materials, direct labor, direct expenses. Then you're also going to add your variable production overheads. Apart from that, apart from knowing how you determine your production cost using marginal costing, it is also important that we remind ourselves how we determine contribution. So contribution is the difference between your selling price and your variable costs. So it is a difference between selling price and variable cost. This particular concept was covered when we were talking about cost volume profit analysis, both in intermediate level, and we have also covered it in advanced level. However, today I want us to talk about the various applications of marginal costing. So today I want us to talk about the various applications of marginal costing. So the applications of marginal costing is what I want us to do what? To talk about. The applications of marginal who? Remember, we've said marginal costing is also known as direct costing. It is also known as what? Contribution costing. It is also known as variable costing. It is also known as variable costing. Why? Because you normally calculate your production cost by considering only variable production what? Costs. Only variable production costs. All right. The first application of marginal costing, application number 1 that we will talk about is what we refer to as limiting factor. It is known as limiting what? Factor analysis. We have a second application known as throughput analysis. Throughput analysis is the second application. You have make or buy decisions. Number 4, you have special offer decisions. Number 5, you have drop or continue decisions. Let me start by highlighting the first application of marginal costing. Let me highlight or talk about the first application of marginal. And the first application is limiting factor analysis. Limiting factor is what is referred to as a scarce resource. So a limiting factor is a resource that is not enough, such that it will normally prevent the company from meeting its demand. So limiting factor is a scarce what? Resource. This is a scarce resource. A resource that is not enough, i.e. a resource that is not what? Enough, or is limited in its availability. It is limited in its what? Availability. I.e. it is not what? Enough. That resource that is not enough, it may be materials, it may be labor, it may be production capacity, it may be even what? Space. Okay? As an organization, when you are faced with a limiting factor or where you don't have enough resources, you are going to maximize the contribution per limiting what? Factor. So when you don't have enough resources, you as an organization should decide on the units and the product of the product you're going to do what? Produce, such that these products that you're going to produce are the ones that are going to generate the maximum contribution. Now, for us to be able to deal with a question on limiting factor, or for us to be able to identify the product that will maximize the contribution per limiting factor, we must always start by identifying the what? The limiting factor. So the steps that we follow when you want to identify your limiting factor units to produce, steps to follow. Number 1, start by identifying your limiting what? Factor. You determine limiting what? Factor. Once you've determined the limiting factor, the second step is determine your contribution. You must determine your contribution per unit, per product. You determine your contribution per unit, per who? Per product. Number 4 is you're going to determine your contribution, per limiting factor, per who? Per unit, per who? Per product. Per unit, per who? Per product. Next step after that is to determine your to rank or to determine the rank of your products. And the rank here, or the products that you're going to rank, will be ranked that the product with the highest contribution per limiting factor will be ranked first. Will be ranked what? First. And remember that the contribution per limiting factor per what? Per unit will have been computed by note number 4. Will have been computed by step number 3, not number 4, by step number 3. So we are saying you rank according to the highest contribution, per limiting factor per unit. That should be your order of what? Rank. Then step number 5, you determine your optimal who? Output. And this optimal output will be according to the rank above. According to the rank what? Above in step what? In step who? D. This step here above. Right. That are the basic steps, or those are the steps that are going to be used when an organization is faced with a limiting what? Factor, a scarce resource. And we can have an illustration. And our first illustration, the illustration I want us to talk about, is a question of April 2022. April 2020. Question 2A. April 2022. Question 2A. The question states, Zinc Limited is a local manufacturer of 3 products, namely X, Y, and Z. The management of the company is unhappy with the current production mix and is seeking advice on the most optimal arrangement. The current production is 10,000 units of X, 5,000 units of Y, and 6,000 units of Z. The management accountant has provided the following information relating to the 3 products. You have your details. You have the product X and Y. The selling price per unit of X is 1,200, of Y is 2,000, of Z is 2,250. Your production cost of materials is 300, of Y is 900, of Z is 600. Your variable overheads of X is 150, of Y is 400, of Z is 450. Additional information. Each type of product passes through 3 departments in which a different type of labor is used. The labor requirements in each department are given below. Department 1, your rate per hour is 20 shillings per hour, where X requires 3 hours per unit, Y 4 hours per unit, Z 6 hours per unit. Department 2, the rate per hour is 40 shillings per hour. Your labor requirements are 1 hour per unit in X, 2.5 hours per unit in Y, 4 hours per unit in Z. Department 3, your rate per hour is 30 shillings. Your labor requirements per unit of X is 5, Y is 7, and Z is 9. Number 2, if there is a shortage of labor in Department 2 and it is not possible to increase labor input hours beyond the fully utilized current hours. Fixed overheads are budgeted at 5 million shillings per annum and are expected to remain constant. A recent market survey disclosed that the maximum sales potential for the company is 12,500 units of X, 7,500 units of Y, and 8,000 units of Z. Advise the management of Zinc Limited on the most profitable production mix and the optimal profit using limiting factor. So I want us to tackle this question of April 2022. Question what? 2A. Let me have that here. We will follow the steps as I have indicated. It is limiting factor, remember. Okay. So the first step is you first determine the limiting what? Factor. That is step number 1. So we even write here. Step 1. A. Determine limiting what? Factor. Going to guide you through this slowly so that you see what is happening. So determine limiting what? That is the first step. The limiting factor will be determined by comparing the available resources with the required what? Resource. So here we compare our available what? Resource with your required resource. They are saying currently, note number 2, that there is a shortage of labor in Department 2. So here you're going to say your available labor hours in Department what? 2. Your available hours in Department 2, you're going to have to calculate them now that you've not been given how many hours are available. But additional information number 1, each type of product passes through 3 departments in which a different type of labor is used. The labor requirements in each department are given below. The labor requirements per unit of X in Department 2 is 1 hour. But for you to produce X, yeah, you currently are producing how many units? 10,000. Currently are producing 10,000 units. Therefore, for you, the normal or the available labor hours will be dedicated to produce X are how many hours? 10,000 hours. Why? Your labor requirements per unit is how much? 2.5, and your current production is how many units? 5,000 units. Therefore, the labor requirements of what? Of Y will be what? 2.5 by who? By 5,000, which in this case will be how much? 12,500 what? Hours. The third product is who? Z. And to produce Z, you will use 4 hours per unit. You multiply that by your current production, which is 6,000 what? Units. So for you to produce Z, you require 24,000 what? Labor hours in Department what? 2. Then after that, you now determine all your total labor hours that the current Department 2 has. All the labor hours that are available in Department 2 for Zinc Limited. And how many hours do you have available? 46,500 who? Once you've determined your available labor hours, what do you then need to do? To determine your who? You will need to determine your required labor hours. Your required labor hours in department who? In department who? Again, you will need to produce X, you will need to produce Y, and you also need to produce who? Z. For you to produce a single unit of X, you need 1 hour per unit, but the market demand, according to a survey that was conducted, is that you have a potential to sell 12,500 what? Units. Therefore, you will require 12,500 who? Hours to be able to fulfill that particular what? Demand. Why? You have 2.5 hours per unit, but the market demands that you produce 7,500 who? Units. Therefore, you require how many hours? You require 18,750 hours. Then Z, you require 4 hours per unit, or you'll be using 4 hours to produce a single unit, but your demand in the market is of 8,000 units. Therefore, your total required labor hours are 32,000. So you add this 12,500 plus 18,750 plus 32,000. So here you will need, or you require, 63,250 hours. 63,250 hours in which department? In department 2. And let's see how much deficit we have. Let's see the deficit. Available labor hours are 46,500 labor hours, but what you currently require is 63 what? 250. Therefore, you have a deficit or a shortage or a shortfall of 46,500, 63,250. Therefore, you have a shortage of 16,700 and what? 50 skilled labor hours in department what? 2. Labor hours in department. Now, because you don't have enough hours here to produce all these units of what? X, Y, and Z, you must decide of the 3 products, which one am I going to produce first? Which one am I going to produce last? Apart from deciding the order of the products you're going to produce, you also will need to determine the units of each product that you are going to produce in that particular what? Period. For us to do that, now that we've determined our limiting factor, we will determine our contribution per unit per who? Per product. But before we determine that, let us therefore here say, therefore, your labor hours in skilled, in department 2 rather, in department 2, it is the limiting what? Factor. The limiting who? That is a limiting factor. How do we know? Because here we have a what? A shortfall or a deficit. You require for 63, but you only have what? 46. You can only use what you have, okay? So therefore, your limiting factor per unit, X is who? 1 hour per unit. Y is who? Is 2.5 hours per unit. And Z, lastly, is 4 hours per who? Per unit. 4 hours per unit. That is the limiting factor per who? Units. And that is also how you determine your limiting factor. Remember, we said a limiting factor is a scarce resource. Those hours of 16,750 represent the scarce hours you don't have. Step number 2 here, is to determine your contribution per unit per who? Per product. So let's determine our contribution per unit per product. Contribution per unit. To determine contribution per who? Per unit. Let's determine contribution per unit. How do you determine contribution per unit? The contribution per unit is normally calculated by taking the difference of your selling price per unit and your total variable cost. So we can start with the first product. The first product is known as what? Again, you're going to take your selling price per unit. Your selling price per unit of X is 1200. You less your variable cost, and the first variable cost is the cost of direct materials. And your material cost is how much? 300. You have another variable overhead cost, is your other variable cost, which is 150. Then you also have a cost known as direct labor cost. And your labor cost was in department 1, department 2, and department 3. Department 1, you are using 3 hours. Department 1, you are using 3 hours at a rate of how much? 20. So that your labor cost is how much? 60. Department 2, let me say, department 1 is being paid at how much? 20 shillings per hour. So if you work for 3 hours, you're going to be paid 60 shillings. Department 2, you're being paid at 40 shillings per hour. And department 2, they worked for how many hours? 1 hour. So therefore, they were entitled a cost of how much? 40. Department 3, they're working for 30 shillings per hour. And they worked for how many hours? 5. So 30 by 5 must be 150. Then we determine our contribution per unit. We've said the contribution per unit is simply the difference between your selling price and all your variable what? Costs. Let's go to Y. Your selling price per unit ni ngapi? 2000. Your material cost is 900. Your variable overhead is what? 400. Your labor cost in department 1, which was paid at 20 shillings per hour, but they worked for 4 hours. So 20 by 4 is 80. Department 2, they worked for 2.5 hours. They worked for 2.5 hours, but each hour is being paid at how much? 40. So therefore, they will be paid how much? 100 shillings. Department 3, they worked for 7 hours and each hour is being paid at 30. So that they will be paid how much? 10. The other department is department who? Z. Your selling price 2250. Material cost 600. Variable overhead cost 450. Labor cost of 6 by 20 120. Department 2, 40 hours per hour by 4 hours is 160. 30 hours, 30 shillings per hour by 9 must be 270. Then we now get our contribution. The difference between what? Selling price and all your variable costs and all the variable costs. Okay, so let's calculate it now. Let's calculate it. Remember, we are determining our contribution per unit. 1200 minus 300 minus 150 minus 60 minus 40 minus 100 and what? 50. The contribution per unit of X will be 500. 2000 minus 900 minus 400 minus 80 minus 100 minus 200 and who? 10. 210. 2250 minus 600 minus 450 minus 120 minus 160 minus 270. That must be 600 and what? Step number 2 is done. So let's go to step number 3. Step number 3. I hope we are together. We have successfully determined the contribution per unit. The next step on dealing with limiting factor is to determine your contribution per who? Per limiting factor per unit. So let's go to step number 3. Factor per unit. Determine contribution per limiting factor per unit. You have X, you have Y, and lastly you have which product? Z. To determine the contribution per limiting factor per unit, you're simply going to take your contribution you divide that by your limiting factor. And your limiting factor, remember we said, is your labor who? Hours. So you're going to divide this by your labor who? Hours. You're going to divide that by your labor what? Hours. Your labor hours. Per unit, X, Y, Z. The contribution per unit is as per step 2, 500, 310 and 650. 500, 310, and lastly how much? 650. You divide that by your labor hours per unit. That is the limiting factor. Remember, these labor hours per unit are the limiting factor. X is 1 hour, Y is 2.5, Z is 4. So you say 1 hour per unit, 2.5 hours per unit, and 4 hours per who? Per unit. So this will give you your contribution per labor hour per unit. Per labor hour per who? Per unit. 500 divided by 1 is 500. Then 310 divided by 2.5 must be 124. 650 divided by 4 must be 162.5. 162.5. We have determined the contribution per limiting factor by simply doing what? By taking the contribution, you divide by your limiting what? Factor. And remember, your limiting factor was the labor what? Hours. It was the labor hours. The fourth step is to rank, or what we simply denote as priority ranks. When we say priority rank of production, it is basically you want to identify of the 3 products you want to produce. Which one will you produce first? Which one will you produce second? Which one will you produce the third one or the last one? You want to produce X, Y, and who? Z. Now, the ranking here is normally based on what? It is based by the maximum, or you compute it, or you consider your maximum contribution per limiting factor. So once you've determined your contribution per limiting factor, you're going to look at the one with the maximum what? Contribution per limiting factor, that you're going to rank it as number 1. Then the second, you're going to rank it as number 2, and so on and so forth. Our contribution per limiting factor, which is your contribution per labor hour per unit, was how much? 500 for X, 124 for Y, and 162.5 for who? Z. Then you do what? Rank. According to the contribution per limiting factor above, the first rank should be product 1. Product 1, which is what? X. Let me write that using a different color pen. Product 1. Then product 2 is Z. Then product 3 is Y. Because the one with the highest contribution per limiting factor is X. Then the next highest is Z. Then the least highest is what? Y. That is step number 4. Step number 5 is now to determine the units of output of each product that you're going to do what? That you're going to produce. What we refer to as optimal production mix. Optimal production what? Mix. So here we want to identify according to the ranks here, and now that we only have 46,500 hours, how many products of each product are we going to produce? How many units of each product are we going to produce? So you're going to start here by identifying the products according to the rank here. Then have your available limiting factor, and we know what is our available limiting factor. Your available limiting factor is your labor who? Hours. Your labor hours was the limiting factor. Then your required labor hours, which is now your required limiting factor. Then lastly, you have your output, and your output is in what? Units. Your output is in units. Wonderful. The first product we want to produce according to our rank is what? X. So here we write product X. The available hours that organization currently have is 46,500 hours. So here you write 46,500 who? Hours. For you to produce product X, the required labor hours here are how many hours? 12,500. 12,500. And then now we need to identify our output. Okay, but remember that X, for you to produce a single unit, you are using how many hours? 1 hour. So if you have 12,500 labor hours, how many units are you going to do what? To produce. So what will you do? You're simply going to take your required hours, 12,500, you divide by the labor hours per unit, which in this case was how much? 1 hour. So at the end of it all, you will need to produce 12,500 units. 12,500 units. The next product according to our rank is product Z. We write here product Z. Now your available hours will have to do what? To change. Why? Before production of X, you had 46,500 labor hours, but you have used how many labor hours? 12,500. So for you to produce Z and Y, you only have how many labor hours now available? 34,000 labor hours, which is simply 46,500 minus 12,500 to give you 34,000. Then we ask ourselves, for us to produce Z, how many labor hours do we require? And we require how many labor hours of Z? 32,000. 32,000. So here we are going to write how many hours? 32,000. Then let's identify the units we want to do what? Produce of Z. For you to produce a single unit of Z, you required how many hours? 4 hours per unit here. If you currently have 32,000 labor hours, how many units are you going to use to produce? So you will take 32,000, you divide by by 4. So you're going to produce how many units? 8,000 units. 8,000 units. The last product that we will produce, that we should produce, is product Y, because it is the one that was ranked number 3. For you, before you produced Z, you had 34,000 labor hours, but you have used 32,000. So therefore, how many hours are remaining? 2,000. But for you to produce Y, you require how many labor hours? 18,750. Now that you don't have 18,750, how many hours are you going to use? 2,000. Remember, you can only use what you have. Okay, so here, even if you require 18,750 hours to produce Y, what do you currently have available? 2,000. And these 2,000 labor hours are the ones you're going to use to produce a certain number of units of